almost June, isn't it?
Almost June, Joe.
So did you check with someone that may have seen a lot of previous Junes that you might still be in contact with? Did you talk to your dad about this? Did he, or is this you?
Oh, absolutely. He sends his regards to you, as he always does.
June, don't be surprised after a bad May whether June is a better month. Yeah?
Well, if you remember that this was the third best year-to-date performance through the end of April since World War II. And in the subsequent May, the market went down 60% of the time. Yet
he was there for all that stuff. That's the thing.
Exactly. So of course, he was fighting in Italy at the time, but.
So June, there is a possibility that this doesn't go that much further. We heard that from Katie Stockton yesterday, 27.11, I think she said, but it could go below on this S&P. I'm talking
right.
about.
It's a possibility. I mean, you've got another week really in which to shake things out pretty dynamically. Right now, we're testing the 2,800 level on the S&P 500. I think that's a very important support level. And then once you go below that, then you're dealing, as Katie said, with the low 2,700 region. So right now, prices lead fundamentals, and right now the technicals are giving us the signal that there's further weakness ahead.
Ellen, I don't know whether you're ready to call the end of this cycle, but it is a little bit late stage. And one of the things you look at are NPLs, commercial non-performing loans. But it's been how long that we've been seeing some that sort of as a red flag?
So in terms of the non-performing loans, it's really just the first quarter where that began to tick up. So if you look at non-performing loans going back, they've been on a pretty steady decline since the beginning of 2010, with little fits and starts, but generally a very significant decline. Long-term averages for non-performing loans in banks is just under 1% of loans, so maybe 0.95 or so. And it had been hovering just below half a point, so a good 50% of average. And what we saw in the first quarter is if you add up all the non-performing loans of all the U.S. banks, large, mid, small, they ticked up from about 50 basis points to somewhere over 55, close to 60 basis points. So it's still very, very low relative to history, but it's just something to watch, because if we see this continue for the next couple of quarters, it certainly is what I would call a yellow flag that we're watching, along with, of course, the yield curve.
I mean, the Morgan Stanley comments, I read some of those as well. The gentleman there that I guess their chief market strategist was pretty bearish in 2018. He's been bearish for 2019 and wrong kind of so far. But do you think we go to 2,700 and stay there, or end the year based on a slowdown or even a recession or recession fears? What are we doing at 220 on the 10-year?
Certainly, the curve looks like it may be beginning to invert. The 2s to 10s, which we look at, hasn't inverted yet, but the rest of it has begun to look increasingly problematic as we go forward. But we take a really big step back, and we look at what's happening with the underlying economy. Unemployment still very good. The PMIs took a nosedive last week, as we saw, but they're still above 50, which is still expansionary. And we would argue that some portion of that was actually due to all the trade rhetoric being very loud at the time that those surveys were taken.
You know, one thing, though, some of the weakness that we've seen are from numbers that were from April, and that was before the trade rhetoric really ramped up. Do you have any concerns about the underlying economy, even if you strip the trade war out?
The underlying economy is late cycle and it is slowing. So yes, I am concerned, but I'm not inordinately concerned for the rest of this year. You're looking at S&P earnings growth that are going to slow from over 20% last year to something more like mid-single digits this year, maybe high single digits. But the underlying market is not too expensive given where the 10-year now. You're looking at pretty reasonable valuations, 17 times this year, 15.5 times next year. And the important thing is not to be out of the market late cycle. It matters where you are in the market. So you want to be rotating into quality. And for us, that means by quality, I mean growth, certainly growth at a reasonable price, but also high returns on invested capital.
All right, what do we do for the rest of the year, Sam?
Well, the rest of the year, I think what you do is you acknowledge the fact that we're going through a pretty challenging May through October period. Normally, it's best to rotate, as Ellen said, going into the traditional defensive havens of consumer staples and healthcare. But I would tend to say that once this is behind us, that we end up with a fairly positive end-of-year seasonal rally. Normally, that's what we find to be the case following very strong openings to years.
And then you would stay long next year. or not?
Yeah, I mean, a little too early to say right now. I think a lot of investment strategists are like nighttime drivers who only use their low beams. So I'm willing to forecast out about 12 months right now. Earnings estimates are expected to be up about 12% in 2020 versus the 2.5% that S&P Capital IQ is projecting now. So the high bar that we had to deal with this year will obviously be lowered next.
That's saying something. Obviously, you're not saying we're going to 2,200 on the S&P or something like that, right?
I don't.
Positive. You think we're a sustained upward trend?
Bull markets don't die of old age; they die of fright, and what they're most afraid of is recession. We are not really looking. Sorry?
Not the Fed anymore.
Well, the Fed is part of it.
The Fed cut? Kramer's back.
What's interesting is that we are in a flat to inverted yield curve environment now, and in the last 40 years, a flat to inverted yield curve we've had 7 of those, have only led to 4 recessions, but 7 out of 7 rate cutting cycles. So maybe what the market is hoping for is that we end up with a weaker than expected PCE number tomorrow, which increases the likelihood that the Fed does start to lower rates.
Now, you had that fact too, or Bob gave you that one too? Does he? Do you have an IFB? You don't? Okay. Is he talking to you right now? He's not.
Telepathically.
Okay. Is he 90 yet?
93.
God bless him. Awesome. All right. Well, that's a lot of wisdom. So
awful lot of wisdom that I've learned from. Right.
All right.